Hey everyone, and welcome to This Explainer. Today, we're taking on a genuinely massive topic, the stock market. But, we're going to look at it through a slightly different lens. For a moment, I want you to just completely forget about all the complex financial jargon, the flashing numbers, the confusing charts. We can actually understand exactly how this massive global financial machine works by looking at something we're all incredibly familiar with, a simple, everyday house auction.
Okay, let's dive into this with a quote that really perfectly sets up our core thesis for today. If you understand how a house auction works, you've already understood the basic principle of the stock market. It really is that straightforward. One of the biggest misconceptions out there is that the stock market is this impossibly complicated puzzle, some deep mystery reserved only for Wall Street experts. But honestly, the core basic concept is surprisingly simple. The true challenge isn't actually understanding how the machine works, it's learning how to participate in it consistently. And that is exactly what we're going to map out for you today.
Which brings us right into Act 1, the house auction, and understanding the bidding war. So, I want you to imagine a really nice house for sale, right in your own neighborhood. The owner wants to sell today, and a pretty big crowd of interested buyers gathers around. Now, obviously, every buyer has a slightly different opinion on what this place is actually worth. The seller starts things off and asks for 50 lakhs. Well, one buyer immediately agrees, saying, "Done, I'll take it for 50." But wait, another buyer really wants this house and shouts out an offer for 52 lakhs. Then the third buyer, who let's say has been hunting in this specific locality for months, jumps in at 55 lakhs. Finally, a buyer who is absolutely desperate not to lose out yells 58 lakhs. Now, think about what's actually happening here. The physical house hasn't changed one bit, right? No extra bedrooms were miraculously built during the auction. The location is the exact same. So why on earth did the price jump up? Simply because more people were willing to pay a higher price than before. The buyers are competing against each other.
And you know what? We can seamlessly map this exact same mechanic straight onto the stock market. A stock price rises or falls based on belief and demand, not magic. So why do prices go up? Just like that house, it happens when buyers are competing. Maybe a company reports excellent profits. Maybe they launch an incredibly innovative new product. Or foreign investors are aggressively buying in. The investors believe the future looks bright, so demand totally outpaces supply. And conversely, why do prices go down? Well, when weak earnings hit, or there's an economic slowdown, maybe rising interest rates, or just general fear creeping into the market. The mechanics are literally identical to our neighborhood auction.
Let's actually see that downward pressure in action. Fast forward a few months, and that exact same house is back on the market. But this time, bad news hits. Word gets out about a severe water shortage in the area, plus there's whispers of a messy legal dispute over the land. Yikes. The seller confidently asks for 60 lakhs, really hoping for a premium. But the buyers, they respond very differently now. One tentatively offers 56 lakhs. Another drops their bid down to 54. A third offers a mere 52 lakhs. The seller waits around, really hoping for a better offer, but absolutely no one is willing to pay 60. Eventually, the seller is forced to accept that 52 lakh offer. Again, the walls of the house didn't collapse, but the buyers retreated. When more people want to sell than buy, prices have nowhere to go but down.
And that perfectly transitions us into Act 2, supply and demand, the invisible mechanics. Let's look at extreme demand first. Picture this. Imagine there is literally only one single house available on the market, but you have 100 highly motivated buyers lined up around the block. What's going to happen? Those buyers are going to fiercely compete with one another. When extreme demand meets extremely limited supply like that, buyers just continuously outbid each other, and prices usually skyrocket.
Now, contrast that with the exact inverse scenario. Imagine 100 identical houses are suddenly up for sale on the exact same street, but only 5 buyers actually show up to look at them. The power dynamic completely flips on its head. Now, the sellers must fiercely compete for that tiny little pool of buyers, slashing their asking prices left and right just to get noticed. The result? Sellers concede and prices inevitably fall.
So, the crucial point is this golden rule right here. When both the buyer and seller agree, a trade takes place. And that specific transaction instantly becomes the latest market price. There is no magic button somewhere pushing prices higher or lower. It is simply an ongoing, relentless negotiation repeating millions of times a day. Every single second, a buyer is basically saying, "Hey, I'm willing to buy at this price," and a seller is saying, "I'm willing to sell at this price." When those two numbers match, boom, a trade happens. Let's expand our lens a bit with Act 3, the wider financial ecosystem, going way beyond just company shares. See, when most people hear stock market, they usually just think of the equity market, buying ownership in massive companies like Reliance or TCS. But the ecosystem is so much larger than that. You have the derivatives market, where traders are buying contracts like futures and options that are linked to another asset's value. Then you have the commodity market, where participants trade actual, physical, tangible goods, stuff like gold, silver, and crude oil. Prices in commodities can swing wildly based on global demand, weather events, or geopolitical tensions. But that underlying auction mechanism, it's exactly the same as our suburban house.
And continuing to expand that ecosystem, we move into currencies, digital assets, and debt. In the Forex market, currencies like the US dollar against the Indian rupee are being traded constantly. The cryptocurrency market trades digital assets like Bitcoin and Ethereum literally around the clock, driven by tech adoption and overall investor sentiment. Then there's the bond market, where instead of buying ownership, you are essentially lending money to governments or large corporations. And finally, funds, like the Nifty 50 ETF or real estate investment trusts. The beautiful underlying truth here is that whether you are buying a physical house, a barrel of crude oil, a US Treasury bond, or a Bitcoin, one single principle governs them all: supply, demand, and negotiation.
Which brings us to a definition that totally debunks the absolute biggest misunderstanding beginners have when they first look at a chart. Listen to me. The market is not driven by luck, it is not a mystery, and it's certainly not controlled by some secret cabal of operators out to get you. Now, while large institutions absolutely can influence short-term movements, the market itself is fundamentally driven by the collective decisions of millions of participants. It's every individual investor, massive pension fund, bank, and automated algorithmic trading system all acting in real time. Every single candlestick you see on a chart is just a visual reflection of collective human decisions happening right then and there.
And that brings us to our final chapter, Act 4, Simple but Not Easy, and the Reality of Trading. And this brilliantly illustrates the need for a quick reality check about the psychology of the trader themselves. Look, trading is conceptually simple. Learning how to click a button and place a trade is incredibly easy. And as we've seen, understanding why prices move makes total logical sense. But trading is not easy when it comes to consistently making profits over a long period of time. There is a massive, massive gulf between understanding the raw mechanics and actually surviving the psychological daily grind of the market. Notice what is noticeably absent from the requirements for consistent profits here. There is no secret indicator, no magic crystal ball. What is strictly required is knowledge, patience, discipline, risk management, emotional control, and a proven system. The market consistently rewards those who can rigorously follow a defined process, people who manage their risk incredibly tightly when they're wrong, and who keep their emotions completely in check when they are right. So we're going to conclude this explainer with a provocative final thought, and it's one that I want you to really ponder today. Success doesn't come from finding some hidden secret strategy. It comes from mastering yourself. You now understand the auction, you understand supply and demand, you know the mechanics, but the ultimate deciding variable in the market isn't the price of the stock, it's you. Are you ready to master your own psychology to participate in this incredible global negotiation? Really think about it. Thanks so much for hanging out and joining me today, and I'll catch you on the next one.